At scale, portfolio results are driven by where the capital sits. Get the structure wrong and compounding won't bail you out. You feel it most once a portfolio crosses $1 million. At that level, allocation mistakes matter more than individual picks, because volatility is hitting a much larger base. And small mismatches don't just reduce returns, they start pushing your behavior. I'm Mia Harrison. This channel focuses on asset allocation, portfolio management, and real estate versus equities, the system decisions that shape long-term results. In the next few minutes, I'll explain a role-based framework, what stocks, bonds, and real estate are each responsible for, and I'll end with a checklist you can run before your next allocation change. Here's a familiar pattern. An investor looks back over several years and thinks, nothing catastrophic happened. No blow-up, no obvious mistake. Yet the portfolio barely moved. Meanwhile, someone with similar starting capital ends up far ahead. The difference is rarely a secret stock. It's positioning set before the year begins and whether it holds up when stress shows up. Once you're here, capital stops being just a growth engine. It becomes a system. That system either absorbs stress or transfers it to you. When stress gets transferred, behavior changes long before returns make it obvious. Losses don't need to be extreme to do damage. What matters is whether your portfolio creates repeated moments where decisions feel urgent, a drawdown, a cash flow shock, a big expense, a headline cycle that turns patience into doubt. Over time, urgency erodes discipline and execution cracks under pressure. So the question becomes, how do you build a system that stays calm? A lot of people try to solve this by copying a simple rule like 60/40ths. Those rules can work when you understand what they're designed to solve. They balance participation in growth with protection from being forced to sell at the worst time. But the right balance depends on cash flow needs, reserves, and how you react to volatility. That's why two people can both say 60/40ths and get different outcomes. So for an actual $1 million portfolio, percentages aren't the first question. Function is. At this scale, capital works best when each dollar has a role. Quick guardrail. This framework isn't universal. If your income is unstable, your reserves are thin, or your net worth is concentrated, you'll adjust. If your portfolio must fund near-term spending, you need lower drawdown tolerance and more liquidity. Diversification doesn't delete volatility. It changes where the stress gets absorbed. Now start with the stress point most people underestimate, equities. On a 6-figure account, a 40% drawdown is uncomfortable. On a 7-figure account, it changes decisions because the dollar impact starts shaping real life. If a move in the market can change what you do next month, your equity weight is probably too high. That's why institutional portfolios don't max out equity exposure. They cap it at the point where volatility stops dictating life choices. For most investors, equity allocation is set by tolerance for disruption, not optimism. Capping equity exposure doesn't mean giving up returns. It means keeping volatility at a level you can live through without changing the plan, because staying invested is what gives compounding the time to work. With function in mind, a survivable portfolio assigns 3 roles. Remember, we're building a system that can take hits and keep you steady. First, growth under uncertainty. That's the job of equities. Public stocks, diversified globally across sectors and regions, remain the primary source of long-term real returns. The trade-off is volatility, and the question is, can you hold through it? Second, stability with optionality. That's the job of bonds. Bonds reduce the probability of being forced to act at the worst possible time. They provide liquidity and a place to rebalance from when equities fall. They won't protect you in every environment, but they cut the odds that one bad period forces permanent decisions. Third, inflation-resistant cash flow. That's where real estate fits. Rental income is contractual, expenses adjust with inflation, and real estate doesn't reprice continuously. That illiquidity can reduce feedback loops that push people into bad moves. It also creates constraints, transaction costs, leverage risk, and low flexibility. So it's a role that has to be sized realistically. Here's the mapping. Equities absorb growth risk. Bonds absorb timing risk. Real estate absorbs inflation risk. When one component underperforms, the others limit the damage. That's diversification for survivability, so the system stays intact when conditions get uncomfortable. Now we're at the part where portfolios actually win or lose. Execution. Execution matters more than optimization. Rebalancing has to be rules-based, not mood-based. You can do it by time quarterly or semi-annual or by threshold. When weights drift beyond a set band, pick one rule and write it down while the market is calm. Leverage stays conservative, because leverage turns volatility into fragility. Allocation should change with life circumstances, not headlines. If you're building a long-term portfolio, comment system. If you already rebalance with rules, comment rules. Before your next allocation decision, run this checklist. 1. Define the objective, long-term return with survivability. 2. Assign each dollar a role, growth, stability, or inflation-resistant cash flow. 3. Cap equity exposure at the point volatility won't change your life decisions. Point 4. Keep a rules-based rebalancing schedule, by time or by threshold. 5. Adjust allocation based on life circumstances, not headlines. If this helped you think more clearly, hit like and subscribe. It genuinely helps this channel reach more long-term investors. Next video, we'll apply this framework to real estate in 2026 and compare 3 paths: REITs, residential rentals, and commercial real estate, what each requires in capital, time, and risk tolerance. I'll see you in that one.